Hello, Investing Putts back with you again after a couple of weeks. Um, the subscribers on the account is up to about 41, 42, so it's great. At least there's a few people listening. Would love to get some comments and feedback on the content in the comment section. I guess I should say hit like, but don't hit like if you don't like it. Anyway. I'm trading a portfolio of poor man's covered calls in my Merrill-Lynch test account. I'm invested in the 11 Spider Sector ETFs, which you'll see listed here. For example, we have XLB, which is raw materials, and XLC, which is communication services. I also am in 3 international stock funds, EEM, emerging markets, FXI, Chinese large caps, and VGK, Europe. Finally, I have positions in the gold ETF and the long maturity US treasury ETF called TLT. You can see that I have a desired allocation for each security in a $26,500 account. You can see I have equal weighting of the sector ETFs, and then the international stocks are a little different, and then the hedges, gold and bonds are higher. So about 23% hedges. I also have a column for required net delta per contract. So what is that? If you take, for example, XLK, it's one of the more expensive of the sector ETFs at $156.63 per share. So when I trade the poor man's covered call, I buy a leap option, a long option, which controls, in the money long option, which controls 100 shares. So 100 shares equals 100 delta. So if you control 100 shares, if you had 100 shares, for instance, you would have a net exposure of $15,663. So people think that leaps are harmless, but they offer a lot of leverage versus owning shares outright. The typical delta for a leap will be 80. So 80 delta is, roughly $11,000, $12,000. That's a lot in a $26,000 account. So if my desired allocation is $1,500, then this implies a net delta of 9.6. So in other words, I would need to own 9.6 long shares to control $1,500 of XLK. So when you trade the poor man's covered call, you buy deep in the money, long call, the leap, and then sell short calls against the leap. So the delta of the leap minus the delta of the short call gives you your net delta on the position. So how could I achieve a net delta of 10? I could buy a 70 delta leap and sell a 60 delta short call against it. Or I could buy a 60 delta leap and sell a 50 delta short call against it. My preferred approach is to buy the 70 delta leap. Really, I'd like to buy an 80 delta leap because I want to minimize the amount of extrinsic value that I'm paying for. But the 70 delta leap isn't too bad. I like to sell the 50 delta short calls against it because the 50 delta call should have the maximum extrinsic value of any option. As an option seller, I want to maximize the amount of extrinsic value in the options that I sell and minimize the extrinsic value in the options that I buy. So as time goes on, the extrinsic value decays, and if the shares move up or down, the short call goes to a higher or lower delta, and I can buy it back and sell a new one. But the key here is that I'm selling something with a lot of extrinsic value and buying back something with less extrinsic value. So even if the shares go up and the short call goes to 80 delta, there's less proportional amount of extrinsic value in that short call. So I frequently tabulate the delta of the leap and the short call for each security, and I use that to compute a net delta for each security. I can then see how I need to change the net delta of my poor man's covered call position to bring it in line with my desired allocation. So a negative number means I need to reduce the net delta or reduce the total exposure in each security. If it's a positive number, it means I need to increase my exposure. So I can compute the actual position size, the actual exposure for each security, and then add those numbers up. and I get a net leverage for the account. So in this case, it's 136%. If it was 100%, then it means that my net exposure is right on the desired allocation. 136% means I have about 1.36 times leverage over the desired exposure. So when I look at the volatility in my account, I should see 1.36x the volatility for each security. Now, of course, I'm actively hedging the large cap stocks with gold and with bonds, so the net volatility of the account should be reduced relative to just holding stocks themselves. So here's my portfolio's performance in blue compared to the SPY in red and a 60-40 SPY bond mix in yellow. I had a large drawdown in the first week when gold had a big drop and I was apparently overexposed. So from there, I've clawed my way back, and I'm actually now even with the SPY portfolio and beating the 60-40 portfolio. So up until mid-August, I was carrying a lot of leverage, probably 200% or 2-to-1 leverage, without really understanding it. So in August, I got a better understanding of my risk, and I reduced my positions. But you can see up until August, the drawdowns were more severe than the SPY. But on the other hand, as the SPY rose, my position tended to rise more than the SPY. So since August, I've been managing my exposure, trying to keep the leverage below 1.5 to 1. So since the big drawdown in June, I've done pretty well relative to the SPY. So let's see if I can continue that trend and minimize the volatility in the drawdowns. I'm still waiting for a big drawdown. Not that I want a big drawdown, but I want to see how the poor man's covered call performs. So anyway, would love to hear your comments or questions or things you want to hear in the comment section. Until next time, we'll see you.